Imagine walking into your favorite coffee shop, the same one you visited for years. You order your usual, maybe a latte, maybe a croissant. But this time, the price has jumped again, not by a few cents. Enough that you pause and actually do the math in your head. You didn't get a raise. Your rent didn't shrink. But everything costs more. And it's not just you. It's happening everywhere. This isn't bad luck. It's not a glitch. It's something far more powerful and far more invisible. An economic force so quiet, most people don't notice it until it's already stolen a piece of their future. We call it inflation, but that word barely scratches the surface. Because inflation isn't just rising prices, it's the slow erosion of what your money can actually do. It's the reason your grandparents could buy a house with one job, and you're juggling three just to afford rent. And here's the unsettling truth. Once prices rise, they almost never fall back. Not really, not in any meaningful way. Groceries, gas, insurance, even your streaming subscriptions, they climb and then they stay there. Like a tide that only goes one direction. Nobba. So why won't prices stop rising? To answer that, we have to go deeper than headlines or politicians' promises. We have to understand how money itself works, how trust in currency is built, and how easily it can unravel. Because inflation isn't a bug in the system. In many ways, it's a feature. In this series, we'll uncover why inflation is baked into the modern economy, why central banks accept it, and why fighting it often hurts more than living with it. But first, we need to see it for what it truly is, not just numbers on a screen, but a silent reshaping of your life, your choices, and your dreams. Go back just 100 years, to the early 1920s. A loaf of bread cost about 10 cents. A gallon of gas, around 25 cents. You could rent a decent apartment in a major city for $15 a month. Sounds like a dream, doesn't it? But here's what those numbers don't tell you. Back then, the average American worker earned barely $1,000 a year. So that bread, that rent, it still took real effort to afford. Now fast forward. Prices have climbed hundreds, sometimes thousands of %. But wages rose too, just not always at the same pace. And that gap, that's where the pain lives. Because inflation isn't about absolute prices. It's about purchasing power. The actual value of your paycheck in the real world. Look at the data from the US Bureau of Labor Statistics. Since the founding of the Federal Reserve in 1913, the US dollar has lost over 95% of its value. Not in a crash, not overnight, but steadily, quietly, year after year. Even during times of peace, prosperity, and technological miracles, prices kept climbing. And it's not just America. From post-war Britain to modern-day Japan, nearly every industrialized nation shows the same pattern. A gentle, persistent upward slope in prices. Even countries that tried to stamp out inflation like Germany after the hyperinflation of the 1920s eventually accepted a low, steady creep as the price of a stable economy. But why? Why does this happen in almost every modern economy, regardless of politics, culture, or natural resources? The answer lies not in greed or conspiracy, but in the very design of how money is created, how growth is pursued, and how societies choose to balance stability against stagnation. History doesn't repeat, but it does rhyme. And the rhyme we keep hearing is this. Once a society adopts a flexible currency system, one not tied to gold or silver or any physical limit, it gains incredible power to respond to crises, but also surrenders control over the long-term value of its money. So when someone says, prices used to be lower, they're right. But what they're really mourning isn't cheaper coffee. It's stronger purchasing power, and that is a much harder thing to get back. Most people think inflation happens because companies get greedy, or because oil prices spike, or because of some distant war. And sure, those things can push prices up for a while. But they don't explain why inflation keeps coming back, like a tide that never truly recedes. To see the real engine, you have to follow the money, not just how much of it exists, but how it flows through the economy. Picture the financial system as a vast network of pipes. At the very center sits the central bank, the Federal Reserve in the US, the European Central Bank in Europe. When the economy slows or panic hits, that central bank opens a valve. It creates new money, not by printing bills, but by buying bonds, lowering interest rates, and flooding banks with liquidity. This is called monetary policy, and it's meant to keep the system from freezing. But here's what happens next. That new money doesn't spread evenly. It doesn't land in your bank account first. It lands in financial markets, on Wall Street, in corporate balance sheets, in real estate deals. Asset prices rise, stocks soar, housing gets pricier. And only much later, if ever, does that money trickle down to wages or Main Street. Meanwhile, the sheer volume of money in the system grows. Since 2008, the Fed's balance sheet ballooned from under $1 trillion to over $8 trillion by 2022. That's not a typo. 8 trillion. And while not all of that becomes spending money, it changes expectations. Businesses see more demand coming. Workers ask for raises, and prices adjust, not because of one event, but because the whole system is calibrated for more money chasing the same goods. This is demand. Pull inflation, too much money chasing too few goods. But there's another kind cost push, where prices rise because it's more expensive to produce things. Think supply chains snapping during a pandemic, or energy costs surging after a geopolitical crisis. Both types feed each other. And once expectations shift, once people believe, prices will keep rising. They act accordingly. Unions demand higher wages. Companies raise prices preemptively, and inflation becomes self-sustaining. The real engine, then, isn't just printing presses or greedy CEOs. It's the interaction between money creation, human behavior, and the time lag between policy and reality. Central banks can slow it down, but stopping it completely would mean choking off growth, triggering recessions, and risking something far worse than rising prices, economic collapse. So they accept a little inflation. 2% a year, they say, is healthy. But 2% compounded over decades? That's not a gentle nudge. That's a quiet revolution in your wallet, and it never asks permission. In early 2021, as prices began to climb faster than they had in decades, officials stood at podiums and said the same thing over and over. This inflation is transitory. Temporary. A short-term glitch caused by pandemic chaos, shipping containers stuck at ports, factories shut down, workers staying home. Once things reopened, they promised prices would stabilize, maybe even dip back down. But by 2022, grocery bills hadn't shrunk. Rent kept soaring. Used car prices, yes, used cars had doubled. And the word transitory started to sound less like analysis and more like denial. Why did they get it so wrong? Not because they're foolish, but because the models they relied on were built for a different world. One where global supply chains never broke, where energy markets stayed predictable, and where fiscal and monetary policy didn't pour trillions into the economy in a matter of months. Between 2020 and 2021, the US government approved over $5 trillion in pandemic relief. Much of it went directly to households' checks in the mail, expanded unemployment, small business loans. That money wasn't saved, it was spent on furniture, electronics, home renovations. Demand exploded just as supply chains froze. And here's the critical twist. Once that spending wave hit, it didn't just lift prices for a few months. It reset expectations. Businesses saw how much people were willing to pay and realized they could charge more without losing customers. Workers saw their cost of living surge and demanded higher wages. And once wages and prices start chasing each other upward, it's incredibly hard to stop. The Federal Reserve waited too long to react. Interest rates stayed near zero well into 2022, even as inflation hit 9%, the highest in over 40 years. When they finally slammed the brakes, raising rates aggressively, it was already too late to avoid pain. The promise of temporary inflation had already eroded public trust and revealed a deeper truth. In a complex, interconnected economy, shocks don't just pass through, they embed themselves. So when leaders say this time is different, history whispers back, it never really is. Because inflation isn't just about what happened last quarter, it's about what people believe will happen next year, and whether they still trust the system to hold its value. Once that trust cracks, temporary becomes a word you can't take back. We've all hoped for it, that magical moment when the price tags revert, when the gallon of milk costs what it did 3 years ago, when rent stops feeling like a second mortgage. But here's the uncomfortable reality. In a modern economy, prices almost never truly fall, not across the board, not sustainably, and not without something breaking first. Why? Because businesses don't operate in a vacuum. Once a company raises prices and finds customers still buying, it has zero incentive to lower them later. Think about it. If your favorite streaming service bumps its monthly fee from $10 to $15, and you keep paying, why would they ever go back? Even if their costs drop, that extra revenue is now baked into their profits, their hiring plans, their shareholder promises. This is called price stickiness on the way up and downward rigidity on the way down. Wages behave the same way. Workers rarely accept pay cuts, even in recessions. So companies facing fixed labor costs and higher input prices lock in their new pricing permanently. The result? A ratchet effect. Prices tick upward during crises and stay there even after the crisis fades. And it's not just psychology or corporate strategy. The entire financial system is built on the assumption that nominal prices will rise over time. Mortgages, business loans, government budgets, they're all calibrated for a world where tomorrow's dollar buys slightly less than today's. If prices actually started falling, what economists call deflation, it would trigger a chain reaction. Consumers would delay purchases, betting things will be cheaper next month. Businesses would slash investment. Debts would become harder to repay in real terms. Japan learned this the hard way during its lost decades. So central banks don't just tolerate mild inflation, they actively fight deflation. That means even when supply chains heal, even when oil prices drop, the system is engineered to keep the overall price level moving gently upward. Not because anyone wants your groceries to cost more, but because the alternative is seen as far more dangerous. Add to this the long-term pressures we can't ignore. Aging populations shrinking the workforce, climate change disrupting agriculture and energy, and deglobalization making production more expensive. These aren't temporary blips. They're structural shifts that push costs higher for good. So, no, your avocado toast probably won't get cheaper. Not because the world is conspiring against you, but because the economic machinery of the 21st century runs on a slow, steady burn of rising prices. And turning that engine off might do more harm than letting it hum. If prices won't fall and inflation is here to stay, then the real question isn't, when will things go back to normal? It's, how do I protect my life in a world where money quietly loses value every single day? The first step isn't panic, it's awareness. Inflation doesn't hit everyone the same way. If your income grows faster than prices, you're not just keeping up, you're pulling ahead. That's why skills, education, and career momentum matter more than ever. A stagnant job in a rising cost world is a slow leak in your financial boat. But a role with real growth potential, that's your life raft. Next, look at your money. Not just how much you have, but what it's doing. Cash in a savings account earning 0.5% while inflation runs at 3 or 4%. That's not safety. That's surrender. Historically, assets like stocks, real estate, and even certain commodities have outpaced inflation over the long run. Not because they're magic, but because they represent ownership in real things, companies that raise prices, land that retains value, resources people will always need. But you don't need to be a Wall Street trader to act wisely. Start small. Automate savings into low-cost index funds. Pay down high-interest debt, because inflation doesn't lower your credit card rate, it makes that debt heavier in real terms. And rethink consumption. Not every price hike demands your surrender. Sometimes switching brands, buying used, or delaying upgrades isn't sacrifice, it's strategy. And perhaps most importantly, protect your time. Inflation erodes money, but time is the one resource you can't print more of. Every hour spent worrying about prices you can't control is an hour not spent building skills, relationships, or side income that actually moves the needle. Focus on what you can influence: your habits, your network, your resilience. Because here's the quiet truth no one wants to admit: we've never lived in a stable price world. Even in the so-called golden eras of the past, costs rose, just more slowly or hidden in different forms. What's changed isn't the existence of inflation, it's our awareness of it. And with that awareness comes power. You can't stop the tide, but you can learn to swim. And maybe, just maybe, build a boat that rises with it.